Stocks and junk bonds. This divergence appears meaningful. The trends of the junk bond and stock markets tend to be correlated. The reason why is that junk bonds and stocks are closely affiliated in the pecking order of creditors in case of default. The rank of junk bonds is only slightly higher than equities because debt involves a contract. Given these two markets are usually correlated, it's worth paying attention when a divergence takes place. Indeed, a divergence is in the works now. In other words, while stocks have been holding up, the price of junk bonds have been trending lower for much of the year. Here's a headline from a few months ago. Investors shun high-yield bonds on recession, banking risks. At the same time, as mentioned, the S&P 500 and especially the Nasdaq has remained elevated. Our June 16th U.S. short-term update discussed this divergence as the thrice-weekly publication showed this chart and said, the graph shows that junk bonds diverged relative to stocks at the January 2022 peak, when stocks started their bear market. Both trends then came into alignment during the decline, as well as the counter-trend rallies that were interspersed in the sell-off. Everything was aligned until February 2nd, which is when the yield on junk bonds made a low, shown as a high on the inverted chart. Yields then started to rise, but instead of stocks declining, which would keep both trends side by side, equities continued to rally. This divergence appears meaningful. The U.S. short-term update goes on to say that this divergence is not meant to be used for near-term market timing, but it is an indicator to keep in mind, along with other indicators, as well as the Elliott wave model. Indeed, this issue of the U.S. short-term update mentions another indicator which has reached extremes. Get our latest insights into U.S. stocks, bonds, gold, silver, the U.S. dollar, and much more by following the link below this video.